Welcome, traders, to another lesson, price action lesson, including indicators. And we finished last week the bearish engulfing. I think it was a bearish engulfing. And this week, we are ready for the head and shoulders. Guys, head and shoulders is very important. It's a trend reversal formation. And I will include here the head and shoulders and also the inverse head and shoulders. I thought about it, and I think it makes no sense to create a full single lesson for the inverse head and shoulders. I think it's not necessary, because if you understood the head and shoulders, then it would be also easy for you to trade, to analyze, to identify the inverse head and shoulders. Let's talk about it, how we can use it, how we can identify and trade the head and shoulders, and with our to combine with our supply and demand strategy, and also our indicators. Agenda is, of course, bearish price action formation, head and shoulders. The inverse head and shoulders is bullish, but we'll talk about it in a second. And of course, how to trade. And here we have only 2 trade opportunities here, not 3, right? A little bit different. Let's talk about it, guys. It's not so difficult how it looks like, okay? But all the pivots, all the lines, all the highlights here are necessary that you understand the head and shoulder and what it is, okay? The first one is that the first sentence is very important. A head and shoulders formation is a specific chart formation that predicts a bullish to bearish trend reversal. That's it. It is a trend reversal. Okay, it's not only a price reversal like a bearish engulfing. A bearish engulfing is never a trend reversal. What means a trend reversal? That means here in the chart, look on the left side. You can see all the pivots. The green line here, the green arrow, that is an uptrend, right? And we talked about it, that's a trend reversal. It means here, that is a trend reversal, right? You'll change the trend from uptrend to the right side to a downtrend. And that's the reason why we are using a head and shoulders, why we are looking for head and shoulders. Most of the time, a head and shoulders is located on the top here, for example, and we'll see it in the between the uptrend left to the right trend, to the downtrend on the right side. Okay, the head and shoulders formation is a bullish to bearish trend reversal. Bullish to bearish trend reversal, uptrend to downtrend reversal. The pattern appears as a baseline with 3 peaks, where the outside 2 are close and high, and the middle is highest. Okay, we'll talk about it in the next point. Here you can't see really, you're not really see the head and shoulders. I'll show you here. That means the pattern appears as a baseline with 3 peaks. 1, 2, 3. Okay, where the outside 2, that is in the middle, right? This is the outside left, it's the outside right, are close and high. Okay, very close. Look the highs here. Very close, right? And the middle is highest. That is this point here, okay? The head and shoulders pattern forms, and that is the idea behind, not the idea, that's how it forms. The head and shoulders pattern forms when price rises to a peak. Okay, we're an uptrend here, rises to a peak. We create a shoulder and then declines back to the base of the prior up move. Okay, then the price rises above the previous peak. Talking about this, the shoulder, right? Move higher. We form a head that's higher, right? And then declines back to the original base. Boom, right? Finally, the price peaks again from here to here, we create another shoulder at about the level of the first peak of the formation before falling back down. Boom. You understand? Or everything here to the left is still an uptrend, right? We are an uptrend. But then we change the trend. It is a trend reversal. Left, we create a left shoulder, create a head, and then we got a drop, right? We create a right shoulder and then falling down. That is our head and shoulders. We will see this more in the next slides. Again, a head and shoulders formation is a specific chart formation that predicts a bullish to bearish trend reversal line, right? Left side uptrend, right side downtrend. An inverse head and shoulders, we'll talk about also this, is a bearish to bullish trend reversal. That means that's not an uptrend to downtrend reversal, it is a downtrend to uptrend trend reversal. Okay, let's talk about more key takeaways. Head and shoulders. Head and shoulders, again, is a pattern considered one of the most reliable trend reversal patterns. It's a chart formation that predicts a bullish to bearish trend reversal. A head and shoulders pattern is a technical indicator with a chart pattern of 3 peaks, where the two outer, the shoulders, are close and high, and the middle head is the highest. Okay, we talked about it in the chart before. The neckline drawn at the 2 through. Okay, talk about also this, but not now. The neckline, that's a part of another lesson, another slide. Here, inverse head and shoulder, talked about it. Different is, it is a bearish to bullish trend reversal, not a bullish to bearish. That's the opposite. And here we have not 3 peaks, we have 3 throughs, okay? And we will use here the 3 outer 2 shoulders are close and high, and the middle head is the lowest, not the highest, right? It is opposite. The neckline drawn at the 2 peaks, not the 2 through. Let's talk about the neckline again. Now that's a little better here. Sometimes it makes no sense to spend time in a chart. It's too difficult for the beginners. Here it is better that we have lines only. And look, left side, we have this 1, 2, 3, 5 elements. A bullish to bearish trend reversal, shoulders, head, neckline, profit margin. Okay, it's our elements. We have left side, it is an uptrend. Remember, the head and shoulders is a bullish to bearish trend reversal. Bullish to bearish means we have an uptrend here. That's great, right? Also here, more higher highs, higher lows. Okay, we have an uptrend here on the left side. That's necessary. Then we create a shoulder. That's the left, right? Then we move higher. We create a head. The head is above the highest point of the shoulder here. Then we get a drop. We get another rally, a shoulder on the right side. This shoulder, the right shoulder, must lower than the head. Okay, we don't want to create a new higher high. It should be lower than must be lower than the head. And then we get another drop. Means we have our shoulder left, head, shoulder right. We have our head. We have a bullish, right? The uptrend, right side, and downtrend, right? We have lower lows here. High, low, lower high, lower low. It's a lower low. Then we can create a neckline. The neckline is we will connect the shoulder left pivot, lower pivot, with or to the right shoulder lower pivot. That is our neckline. I will show you how we'll use it in the next slides. That's our neckline. And then we have 2 more. That's a profit margin. The profit margin is first the range from the head highest pivot, the vertical line to the neckline. We will touch the neckline. Okay, that's our 100%. And then we will add this 100% to the below. That is our profit margin. That's super crazy. Most of the time, head and shoulders, inverse head and shoulders, the profit margin is exactly on the 200%. That's super crazy, but It's a little magic in the head and shoulders. That is the head and shoulders, guys. Hope it's clear. Not so difficult. It's better here on the line chart, right? Let's talk about the inverse head and shoulders. Of course, it's inverse here. Means we have not an uptrend here. We have a downtrend first. Okay, with lower lows and lower highs. Then this is our shoulder left. Okay, got a drop, shoulder left, a rally, another drop, lower low. This is our head. It must be lower than the shoulder left low. Okay, that's our head. Then we got a rally, a drop, a shoulder right, and this shoulder right, it's not allowed that the shoulder right is lower than the head. The head is the lowest point in this formation. It's not allowed to create a new lower low. Okay, lower low, a shoulder, create a pivot here, shoulder right, and then a rally again to an uptrend. Low, high, higher low, higher high, uptrend, right? Connect also the neckline here, but not below. We connect the neckline now here with the highest point from both shoulders. That's our neckline. 100% is the same here from the head low to the vertical line to the beginning of the neckline. We touch the neckline here, and then add the 100% again for your profit margin. That is the inverse head and shoulders. Key takeaways, guys. Position. The head and shoulders position is on the higher high in an uptrend. Okay, in higher high, head and shoulders is a bullish to bearish trend reversal. That means the head and shoulders should or must form on the higher high area. Here, low, high, higher low, higher high. We need the formation here. Inverse head and shoulders, it is a inverse head and shoulders, a bearish to bullish trend reversal. Means high, low, lower high, lower low. The inverse head and shoulders has to form here in the lower low area. Next one is the shoulder left. Here, for example, in an uptrend, right, with a head and shoulders, not the inverse head and shoulders, price rises to a peak, shoulder, then declines back. That is our shoulder left. Shoulder right is, of course, here price peaks again and create a shoulder at about the level of the first peak of formation before falling back down. Okay, and of course, between the shoulders, left shoulder, right shoulder, we have the head, right? It's in the middle. Look here, that is the shoulder left. Here's your shoulder right, left side uptrend, right side downtrend. The head is the highest point and must located above the two shoulders. More key takeaways, guys. I told you it's a little more difficult. The neckline. Here with a sample of the head and shoulders. And neckline connect lower shoulder left pivot, the lower shoulder left pivot with the lower shoulder right pivot. That's our neckline. Very, very easy. Connect the left shoulder with the right shoulder, the lowest point pivots. Okay, that's it. Then create the range of 100%. We needed to calculate our profit margin then. The range to 100% is connect the range, connect the higher head pivot, okay? The highest pivot on the head vertical to the neckline. That's our 100%. And the profit margin is add another 100% to the downside to calculate your profit margin. That's your profit margin, okay? Very easy, 100%, and here another 100%. And of course, guys, the head and shoulders is a bearish trend formation. That means head and shoulders indicate a potential price reversal to the downside. You want to short, right? The inverse head and shoulders, remember, the inverse head and shoulders is not a bearish to bullish. Inverse head and shoulders is not a bullish to bearish reversal. It is a bullish to Sorry, it's too complicated. Here, the head and shoulders is a bullish to bearish trend reversal, right? We want to short the head and shoulders. The inverse head and shoulders is a bearish to bullish trend reversal. We want to buy an inverse head and shoulders, right? Means here inverse head and shoulders indicate a potential price reversal to the upside. You want to buy. Key takeaways indicator. Guys, here I follow the idea from the bearish engulfing. We talked a lot about the indicators, but it is always the same, right? We're using the seasonality, the COT, the trading day of the month, evaluation, always the same for a bullish and for a bearish trade opportunity, okay? It means it is not different. It depends not on that, or it's not different to the single price action reversals. For example, hanging man, well, we've always the same, right? All the bearish reversals, that means shooting star, bearish engulfing, head and shoulders, are the same idea for the indicators. We need weakness, right? We need weakness. For all the bullish reversals, hammer candle, bullish engulfing, inverse head and shoulders, we need strong indicators, okay? Strong results from the indicators. Here, the idea is from the head and shoulders, right? It's different to the, it's opposite to the inverse head and shoulders. Head and shoulders is, of course, head and shoulders is a bearish reversal, bullish to bearish trend reversal. We need the seasonality, current price located in a selling point, right? Like here, that is the best. Could get a nice drop. Valuation is also should locate it in the bearish area, of course, against your specific valuation asset or assets. The COT for futures only, right? It's not possible to get a result of for stocks or for forex. COT is only futures, right? The commercials should be in the extreme bearish area. That's the best. And trading of the month, of course, at best a cluster of several bearish days. Then we can stay also longer in this trade. That's it for the theory. Now we'll talk about how to trade the head and shoulders. We have only two trade opportunities here, trade action opportunities. I will show you here only the head and shoulders trade opportunities. It is, of course, the opposite to the inverse head and shoulders. I will explain you again in the next lesson, the practical application. I will show you the both trade opportunities for the head and shoulders and also inverse head and shoulders in the chart, okay? Here, let's talk about it. The sample says it is Citigroup, okay? And we created here a head and shoulders. Look, take action option 1. The head and shoulders key takeaways must be met. Remember on our key takeaways here. Head and shoulders key takeaways must be met. Position, shoulder left, shoulder right, the head, neckline, range, profit margin, okay? Everything here, and look, we have a left shoulder, a head shoulder, left shoulder, a head in the middle. The head is the highest point above both shoulders and the right shoulder. We have a neckline here, that's a yellow line. We connect the lowest point of the left shoulder and the right shoulder, our 100% range, and we add the 100% below again for our profit margin. What is here the next step? As soon as the head and shoulders is completed in its respective time frame, we mark both shoulders, the head, neckline, and profit margin. That's our job, okay? Next step is the entry. The head and shoulders, guys, is a short opportunity. The entry, short order, is set slightly lower than the neckline break to avoid possible fake outs, okay? Slightly lower to avoid possible fake outs. Entry is that we extend the neckline, okay? Here we have 2 points, 1 and 2 points. We connect this and then we extend it to the right. And on this point, at the moment, we break the trend line with the price. we can short below the neckline. That is our idea. Short below the neckline. Okay, a little bit below the neckline, right, to avoid fake outs. A little bit. It is the same like the bearish engulfing short below and all of this. Step number 4 is the stop loss is set with a respective distance. For example, blueprint plus 33% above the lower high. Guys, high here, low, lower high, lower low. That is our lower high. We can move our stop loss above the lower high. That is option number 1. Okay. Reward is less. Why? Of course, we have that depends on the neckline, right? The neckline shows to the downside here. It means we have a huge zone. It's completely different that we get a neckline, for example, to the upside. That's also fine. It's not necessary that shows us for downside. It is very big, right? The zone is big. That's the reward is most of the time less. Trigger probability is, of course, one of the best because the neckline, we are waiting for the confirmation. We cross, we break the neckline, then we are filled. And protection is also nice, or all the best. Why? Because the head and shoulders is a bullish to bearish trend reversal. That means we will not, or we expect that we will not violate any lower highs. High, low, lower high, lower low, lower high, lower low, right? We will not break the lower highs. We want to violate the lower lows in a downtrend. That is option number 1. Option number 2, and that's it, guys, is of course the lower time frame, right? That's difficult because we have to use the third step from the process location, direction, zone refinement, right? Lower time frame zones are only zone refinement, right? Here, guys, it is step number 1 is head and shoulders key takeaways must be met. It's the same like option number 1. As soon as the head and shoulders is completed in its respective time frame, don't forget respective time frame. Our head and shoulders based on the weekly chart. That means draw your head and shoulders on the weekly chart. That is a lower time frame chart here already, okay? Because I want to show you the lower time frame. That is, don't change it. You stay or keep your marks on the higher time frame, please. Yeah. We mark the both shoulders. Yes. Complete in its respective time frame. We mark both shoulders, the head, neckline, and profit margin. It is the same, not different. And now number 3 is different. The entry or short can be made market or a set within entire lower time frame supply zone of the right shoulder. That means you will analyze the right shoulder to identify supply, high quality supply, and we got supply here. Look, that is the whole, the S means the right shoulder. Everything in the box here is our right shoulder, okay? And we are looking for high quality supply in this right shoulder. And look what I found. I found this high quality supply. It's a drop-based drop, right? That's our set. That means you can use it on wider or preferred, right? It's up to you. You can also go lower. I think that based on the daily chart, can also go to 60 minutes to 50 minutes, right? Up to you. But our short is a lower time frame supply proximal line, wider or preferred, depends on you. And the stop loss is set with a respective distance, 20 here the blueprint distance, 33% above the lower time frame supply zone, means above the distal line, or also the higher time frame lower high, means you can use also this stop loss here, right, from the option number 1. Again, it is the same, guys. The reward is amazing now, right? We We increased our profit margin. Look at this, really nice. Trigger probability is, of course, a little bit more less because maybe we are never filled, right? That's also possible that we get a drop here without touch the supply and get more and more weakness. Here we are lucky. And protection, that depends. It's here 50%, depends on your stop loss. This is, of course, a little more risky, right? The stop loss is closer to the current price. Should you use this stop loss above the lower high, of course, it is definitely better. That's it, guys. That's option number one, and also option number two. That's a theory. I will show you also the practical application in the next lesson here. Yes. And yeah, I'll include also in the practical application the inverse head and shoulders here. Okay, I was looking for a sample. That's it. Should you have any question, please, guys, comment below this video, this lesson here. Please mention me so I get a notification. Have a good day, guys. Bye-bye.